Hello and welcome to another video on IND AS series. So today we are here to present about IND AS 12, which is income taxes. And if you can see, we are talking about part 1. So how we have bifurcated the entire IND AS is that in today's session we are going to talk about the conceptual understanding of the IND AS 12. We'll also try to give examples to clarify each and every point. And in the part 2, which is going to be very interesting because we are going to come with all the examples for all the possible scenarios, because this is one of the area which seems to be a little bit challenging in terms of understanding, and when we have multiple problems to work upon, then there are some typical issue that needs to be dealt very minutely. So we are going to come with the entire examples that will touch base on each and every situation which is being dealt by IND AS 12. So what we are going to cover today as a part of today's agenda is we're going to touch base about the objective of this standard, scope and the key definitions, what is the concept of temporary difference, current tax, recognition and measurement, deferred tax liability recognition rules, deferred tax asset recognition rules, special cases and exceptions, specifically for initial recognition exemption, goodwill, and investment in subsidiaries and associate, measurement of deferred tax, where to recognize whether in P&L, in OCI or SOCE, which is statement of change in equity, presenting and offsetting, and then differences, if at all we have, between IND AS versus IAS 12. Fundamentally, they are almost same. We do not have any differences, so we may just try to figure out what are the some of the areas if they are different, and we are going to touch base them. This is a quick agenda that we're going to cover today. So moving ahead with the first slide. Okay, so we'll talk about the objective of IND AS 12. So, IND AS 12, as we speak, is prescribed the accounting treatment for the income tax. Principal issue is the accounting for the income taxes and how to account for the current and the future tax consequence. Okay, so we know that when we are talking about the income taxes, we are talking about a separate statute altogether. So we are talking about the Income Tax Act. With respect to the India, we are guided by the Income Tax Act, and our book profits are guided by the framework of the accounting standards, which help us to do a recognition, measurement, and the accounting for those particular assets and liabilities in our books of accounts. Now, when we prepare the accounts, and we come to a number of the profits, and when we try to compare that number with the profit that is subjected to tax, there often tends to be some gap because the fundamentals of accounting is different from the fundamental in which profits are subjected to tax. But there are certain set of the expenses which are fully allowed in my P&L, but those are not allowed in my income tax. And there are certain set of the incomes which are recognized upfront in my books of accounts, but it is recognized differently in my income tax or vice versa. Because of these factors, the profit in my books of accounts tends to be different with the profit which is subjected to my income tax. And because of which the current tax, that is the amount that we are paying to the income tax authority, is the amount which is the taxes applicable on my profit which is reported to my income tax authority. But the total tax expense is equal to the current tax for that particular year plus or minus the DTA or the DTL that we are creating. So DTL is what? Deferred tax liability. So what happened? An entity recognizes a deferred tax liability or asset with a certain limited exception. So we'll talk about this deferred tax liability and deferred tax asset in detail as we move forward, as we move further in these slides. It is inherent to the recognition of asset or liability that reporting entity expects to recover or settle the carrying amount of the asset and liability. It is probable that the recovery or the settlement of that carrying amount will make the future tax payment larger or smaller. That would be such recovery or the settlement were to have a no tax consequences. So we are talking about a situation wherein the profit as per the books of accounts and the profit which is subjected to the tax are different. Now there can be two situations. Either my profit as per the books of account is more as per the profit which is reporting in the Income Tax Act, or it is less. So if my profit as per the books of account is more and my profit as reported in the Income Tax Act is less. So which means that in a current year we are paying the less tax, but we have to pay the more tax in the future year, because those differences are largely the temporary differences, and we are creating the DTL, which is deferred tax liability, or DTA, which is deferred tax assets, only on the temporary differences. So which means that temporary differences will have an impact of reversible got reversed in the future year. So which means that if there is a profit on which we are paying the tax in the current year, that profit as per the Income Tax Act is less. So in which case we have to create a DTL, deferred tax liability, because the profit in the future year would be more, and we have to create the associated liability because of that. However, there can be a situation wherein profit as per the books of account is less, and the profit as reported in the Income Tax Act is more. So in which case we are paying more taxes as compared to the book profit. So in which case we are creating the deferred tax asset. So we have to create deferred tax asset as well as the deferred tax liability. Now it is talking about a situation wherever in IND AS 12 also reveals recognition of deferred tax asset arising from the unused tax losses or the unused tax credit. So there can be situation wherein we have some tax losses, and because of the tax losses, our income tax profit tends to be less, and our book profit is always going to high, because we can set off the earlier income tax losses with the current year tax loss. So in which case we have to create the deferred tax asset on those particular unused losses. But one thing it has to be kept in mind, that the DTA on the losses can only be created if it is probable that in the future year we have a probability of generating the profits, which can then be set off against those DTA. In IND AS 12 is a balance sheet. One important thing is that IND AS 12 is a balance sheet approach. It requires recognition of the tax consequence of difference between the carrying out of asset and liability in their tax base. So which means what? Which means that we have to create the book base. Book base is nothing but the finance account, my financials as per my IND AS, and we have to create tax base, which is nothing but the base basis which we are accounting for the income taxes. Now we have to compare both these base to determine the creation of the DTL and DT or DTA. So we are going to touch base about that of DTL and DTA, how it is getting created by comparing the book base with the tax base in the upcoming slide. But if we try to compare this with IAS 12, so fundamentally IAS 12 is also the same, is also having the same concept as of IND AS 12. So objective of the IND AS 12 is to make sure that we have to do a recognition of DTL and DTA. DTA has to be recognized on the unused tax credit or the unabsorbed tax losses only if it is probable that we are going to have profits in the future, basis which we can adjust that DTA. Otherwise, if it is not, then we will not recognize that DTA in the books of accounts. So we are going to go to next slide and see about the scope of this particular IND AS. Okay, so we'll spend some time in understanding the scope of this IND AS. So it applies to all income taxes, including the domestic and foreign taxes on the taxable profit and withholding taxes on the distribution of the dividend, but does not apply on the government grants of IND AS 20 and the investment credit. So these will be dealt separately in the respective IND AS. So we'll quickly touch base. So which means that if we have to talk about the concept of IND AS, the scope, it is applicable on the income taxes. It includes all the income taxes, including the withholding tax on the distribution of the dividends. So what are the definitions? So accounting profit is the profit before tax as per the books. Taxable profit is the profit as per the Income Tax Act. Current tax is the income tax payable or recoverable for the current period. Okay, now this has to be kept in mind that when you're talking about current tax, it is the tax on the profit as per the Income Tax Act. So which means that tax on the taxable profit for that particular year. This is the current tax. For example, if my book profit is, let's say, 1 lakh, and my taxable profit is, let's say, 80,000, and my rate of tax is 30%, then current tax is equal to the 30% of 80,000, which is my taxable profit multiplied by the tax rate for that particular reporting period, which is like current tax. Deferred tax is the tax payable recoverable in the future due to temporary differences. So any differences which has a tendency of getting reversed in the future year are normally called as a temporary differences, because of which we have to create either the DTA or DTL, because temporary differences are either taxable or deductible. So what did we say? That temporary differences are difference between the carrying amount of an asset or liability in the balance sheet and its tax base. Temporary differences may be either taxable temporary differences or deductible temporary differences. So taxable temporary differences are those differences when we are actually paying less amount of the tax in the current financial year, but we end up paying the more amount of tax in the future accounting year. However, deductible temporary differences are those when we are paying large amount or more amount of tax in the current period, but we end up paying less amount of tax in the future period. So when we're talking about taxable temporary differences, which are temporary differences that will arise, result in a taxable amount in determining the taxable profit for the future period, while the deductible temporary differences, which are temporary differences, which are amount that are deductible determining the taxable profit. So if I have to quickly give one example of DTL and DTA, so taxable temporary differences will create DTL, deductible temporary differences will create DTA. Taxable temporary differences example, if my depreciation in my on my fixed asset is more as compared to what is being charged in my P&L, that is a typical example of creating the DTL, because what we are doing, we are charging more depreciation in the current year and less depreciation in the future. So what will happen, the carrying amount of my asset in the books is more as per the amount which is being there in my tax base. So which means that it will create a deferred tax liability. Reverse situation would be arising when we are creating the deferred tax asset, which are on the deductible temporary differences. This is a typical example when, let's say, we have a particular expense which is being allowed in my books of account, but which is not allowed in my income tax act. So what is happening? We are paying more taxes in the current financial year vis-a-vis the taxes that we are going into the later financial year, and hence in the later financial year we can deduct those expenses once we are doing that specific treatment as per the income tax act. So thumb rule, temporary differences will have the deferred tax implication. Temporary differences are of two types. Temporary differences can be taxable temporary differences and deductible temporary differences. Taxable temporary differences will create the DTL, deferred tax liability. Deductible temporary differences will create DTA, deferred tax asset. Taxable temporary differences will always only arise if my book base in the asset. So there are two things here. So book base of the asset and book base of the liabilities will touch base on each of this concept in the upcoming slide. But for this particular slide, just keep two things in mind. My current tax is the in fact three or four things in mind rather. My current tax is the tax which is payable on the taxable profit as per the rate which is applicable to that year. My deferred tax only arises if there are temporary differences. My temporary differences can be of two types. Deferred tax liability, which arises because of the taxable temporary differences, and deferred tax asset, which will arise because of the deductible temporary differences. We'll move to next slide to have more clarity on this. Okay, so again, a small brief on the deferred tax liability and deferred tax asset. So deferred tax liability are the amount of income tax payable in the future period in respect of a taxable temporary difference. So we discussed that in the last slide. When our tax payout in the current year is less, then definitely we have to create a DTL because our tax in the future would be more. So these are like tax deferred tax liability, which is being payable in the future year. Reverse situation will happen when we are paying more tax in the current financial year. Then definitely we have a tendency to adjust that extra tax that we have paid in the form of deductible tax differences in the future year. And deductible tax differences in the future year in respect of the deductible temporary differences, the carry forward of the unused tax losses, and the carry forward of unused tax credit. So any kind of the losses because of which our profit got adjusted in the current financial year, and we have to create a DTA on that, because in which case our tax for that particular year is going to be less, and hence we have to create the DTA for those. Now, tax base of an asset and liability is the amount attributed to that asset or liability for the tax purpose. Tax expense, tax income comprises the tax expense and the deferred tax expense or the deferred tax income. So what does this mean? Tax base of an asset or liability is determined basis the tax position for that particular asset. For example, I have an asset of 1 lakh rupees on which state line depreciation is being charged in my books of accounts of 10 years. So my book base for that particular asset would be 90,000 at the end of the year. But let's say for that particular asset, it is again SLM, but chargeability rate is 25%. So my tax base for that particular asset would be 75,000 because 1 lakh minus 25,000 is my tax base. So my tax base is the base for the same asset is 75,000, but by book basis for that particular asset is 90,000. So there is a gap between my book base and the tax base. This actually gives rise to a temporary difference. And if we create a percentage of particular temporary difference, it is either a DTL or DTA depending upon the type of the temporary difference. If my difference is taxable temporary differences, then definitely it would be a DTL. But if my difference is deductible temporary differences, then this would be a situation when we have to create the DTA. So we have talked about that deferred tax asset are the amounts of the income tax recoverable in the future period in respect of deductible temporary difference. So see, think of a situation. So we have, let's say, a profit of 1 lakh rupees, right? Now let's say we have a bonus which is being charged to my PNL on accrual basis of, let's say, 40,000, let's say. So which means my book profit is 60,000. But that bonus, when it is getting charged to my income tax, it is only allowed as an expense when it is paid, which would be next financial year. So what would be the situation? My book profit is 60,000, but my taxable profit is 1 lakh, which means I'm paying the tax on 1 lakh, but my books allowed to be pay on tax for 60,000. So we are creating a deferred tax asset to the extent of 1 lakh minus 60,000, which is 40,000. So 40,000 is the deductible temporary difference on which we will create the deferred tax asset. Likewise, we have to create the deferred tax asset for the carry forward of the unused tax losses and the carry forward of the unused tax credit. But the one point which is to be kept in mind is that whenever we are creating the deferred tax asset, we have to make sure that it is probable to recover that particular deferred tax asset in the future year. If it is not probable, that we will not recognize this asset in the books of the accounts. Tax base is the tax base of an asset in the amount that will be deductible for the tax purpose against any taxable economic benefit that will flow to an entity when it recovers the carrying amount of an asset. If those economic benefit will not be taxable, a tax base of, so basically there can be a situation wherein my tax base for a particular asset and the book base is same, in which case there is no differences between the tax base and book base, so there is no temporary difference and there is no concept of DTL and the DTA. The tax base for a liability is the carrying amount less the amount that is being deductible for the tax purpose in respect of that liability in the future period. Same way, like let's say if we have we have received a particular advance in the books of accounts, and there's a separate treatment of that particular advance in the books of account versus the treatment in the Income Tax Act, then it will have a consequence of DTL or DTA as the case may be, depending upon the treatment in the books of account and the Income Tax Act. So we'll go to next slide and try to get this clarity with more examples so that we are clear absolutely what we are trying to say here. Okay, so we'll try to quickly summarize the understanding on the last slide with some examples here. So first example, we are saying that my taxable example is accounting versus taxable profit. Accounting profit as per books is 10 lakh rupees. Tax depreciation lower than the book depreciation by 1 lakh, which is making my taxable profit as 11 lakh rupees. Now thumb rule is that we have to create the current tax. This is my tax rate for the that particular reporting period. So our tax rate assuming 30%, my taxable profit was 11 lakhs. So my current tax would be 30% of 11 lakh, which is 33 lakh. But again, we have to keep one thing in mind that the objective of IND AS is to make sure that we should utilize the impact of the tax on my book profit versus what we have to report in my taxable profit. So which means that my charge to the PNL can be only to the extent of 30% of my 10 lakh. So what we have to do, we have to pass two entries here. Tax expense in the P&L would be charged with 3,30,000 because it is the total current tax plus DTA for that particular financial year, and then provision for tax will be credited with 3,30,000. We have to create one more entry because we are actually paying more tax in the current financial year, and hence we are creating the DTA, and this is a deductible temporary differences. So we have to pay 30% of 1 lakh, which is 30,000 as DTA, and my tax expense will be credited to my PNL would be 30,000. So my total charge to the PNL is 3 lakh only, which is like 30% of 10 lakh. Another example here is taxable temporary differences. Machine cost 10 lakh, book depreciation is 2 lakh. Carrying amount is 8 lakh as per the book base. Tax depreciation is 4 lakh, so my tax base is 6 lakh. So my book base is more, tax base is less, which means that on asset side this will create a DTL. So we have to create the DTL to the extent of 60,000 rupees. And likewise example on deductible temporary differences, which is DTA. Provision for warranty, so we have already covered this, but again this is an example. Provision for warranty is 1 lakh 50,000. Tax law allowed only when actually paid, so which means that in the current year I am paying a particular tax on the amount which is more than the tax in my books of accounts, so which means that I have to create the DTA. Likewise here, so we were actually paying 30,000 more tax as per the books of accounts. My tax as per the books of account was 3 lakh, but we were paying 3 lakh 30,000. Likewise in this case also, because 1 lakh 50,000 is not deductible from my tax, and hence I am paying 45,000 as DTA in my current financial year, and hence this will be recognized as a DTA, and it has to be recognized only if probable that the future taxable profits that will exist. So this is an assessment that has to be made at each financial year whether we are going to recognize the DTA or not. So we'll quickly go to the next slide then. Okay, so current tax recognition and measurement. So current tax has to be recognized basically in the same financial year. Recognize the current tax liability for the unpaid taxes for current period in the prior period. Recognize the current tax asset for the amount paid in excess or the refundable. So measurement using the tax rate, tax laws are negative for substantially. For example, our current tax is on, let's say, 20 lakh rupees at the rate of 25% is 5 lakh. If we have paid advance tax 4 lakh 50,000, then our current tax liability is 50,000. So we have to assess for the current tax as well as the current tax liability. So my current tax advances is 45, 4 lakh 50,000. My current tax liability is 50,000 because total tax was 5 lakh. Out of this 4 lakh 50,000 has been paid in advance. My current tax liability is 50,000. Simple rule for current tax. There's no complication. So whatever has been paid for that particular year has to be recognized for that particular year. Whatever balance is there, we have to pay the taxes for that particular year, so that we are creating the exact provision as per the Income Tax Act. So we'll move to the next slide then. Okay. Now we'll spend some time in understanding the recognition rule for the DTL, deferred tax liability. General rule, recognize DTL for all the taxable temporary difference. As simple as that. Exceptions, initial recognition of the goodwill for which no DTL will be recognized. Initial recognition of an asset and liability in a transaction which is not a business combination and at the time affect neither accounting or the not taxable profit. We'll talk about it. And temporary difference related to the investment in subsidiary. Okay, so these are like three exceptions, and we are going to talk about these three exceptions in the upcoming slides. So we'll just concentrate on the DTL recognition for the time being. So let's just take an example to understand the detail on the revaluation reserve. So land carried at a cost of 10 lakh, revalued at rupees 16 lakh. Revaluation surplus is 6 lakh, which is an OCI. Tax base remain same, 10 lakhs, no revaluation for the tax. So temporary difference, which is my book base, is more than my tax base, 6 lakh, which is like tax rate of 30%. So which means I need to create the 1.8 lakh of DTL. So for better understanding, what we have done, we have created a thumb rule. So there are three things that has to be kept in mind. First, identify the temporary difference. Second, identify whether the temporary difference is deductible or taxable. Third, if it is taxable, then we have to create the DTL. These are three things. Now DTL will be created if my assets, if I'm talking about the asset side of it. So from my asset side, if my book base is more than my tax base, like in this case, my book base was 16 lakh, my tax base was 10 lakh. So wherever in case of asset, my book base is more my tax base is less, then we have to create deferred tax liability. Thumb rule. Likewise, on the liability side, if my tax base is more than my book base, then we have to create deferred tax liability. These are the thumb rule to be considered while creating the DTL. Largely, we have a lot of examples where my book base is more than the tax base, but we do have very rare example when there is a situation when my tax base is more than my book base, specifically on the liability side. Liability side examples would be very less, but we'll still try to give that an example and try to see that how we could able to create the DTL for those kind of transactions. So DTL will be created on the taxable temporary differences, and it will be only created if my book base is more than my tax base on the asset side, and if my tax base is more than my book base on the liability side. So we'll go to example and see that how it works. Okay, so let's just look at the example. We'll have to go step by step to understand in detail the concept of the DTL. So we are going to take very step by step approach to understand this example. So example is that asset side, create DTL when book base is more than my tax base. Okay. Scenario, depreciation difference. Asset cost 1 lakh rupees. Book depreciation state land method 10%, 10,000. Tax depreciation state land method 20%, 20,000. Book base at the end of the year 1 is 90,000 because 1 lakh minus 10,000. Tax base at the end of the year is 80,000, which is 1 lakh minus 20,000. Temporary difference 90,000, which is my book base, minus tax base 80,000. This is my taxable temporary difference. Because book base is greater than tax base, we have to create the DTL. So DTL created 30%, assuming the 30% is the tax rate on 10,000 rupees, which is like 3,000 rupees. Why DTL here? In books, expense depreciation is lower, so accounting profit is higher. Simple. Because what is happening? In books, my depreciation is less and hence my accounting profit is higher. In tax, expense is higher, so taxable profit is lower. Meaning company pay less tax today but will have to pay more tax in the future, and hence we have created the simple. Now we'll come to a different example where my tax so we are talking about, so this is an asset side, we are talking about the liability side. Example, income fully recognized in the books of accounts in the books now but taxed in the future. Tax deferral. Create the DTL when the tax base is more than my book base. Scenario, a company signs a 3-year service contract. Total contract value is 3 lakh rupees. Entire amount is recognized as revenue in the year 1 due to the 115 performance obligations. So all the performance obligations were being performed. We have received the license and we are working on it, and so software licenses were delivered, and hence we have recognized the revenue. So tax law, revenue recognized only when services are rendered, assuming this is a law for the tax. So which means that services are going to render in the 3 years. So as per the income tax, we have to recognize the revenue of 1 lakh every year. So tax base versus book base of the revenue liability. Actually, the liability disappears in the books because revenue is fully recognized. But for the tax purpose, 2 lakh is still taxable in the future, meaning tax base is higher. So which means my second condition satisfied. My tax base is higher than my book base. So book have no liability because the revenue is fully recognized, but tax base has value of 2 lakh rupees. So which means that we have to create the DTL on 2 lakh rupees, which is 60,000 rupees. So two examples are clear now. What we are trying to say, when in the asset side, we have to create a DTL when our book base is more than my tax base, because we are paying less tax in the current year and we are going to pay more tax in the future year. Likewise, on the on the liability side, there is a concept, we have to make sure that our tax base is more than our book base, then we have to create the DTL. Same logic would be applying here. So which means that what we are doing here, we are paying less taxes here because we are paying taxes on 1 lakh of income, then we have to pay more taxes in the future year as the income got recognized. So same logic, we have to pay less taxes and hence we have to create the DTL. So in both the cases the DTL will be created, but on the asset side it will be created when my book base is more than my tax base. On the liability side it will be created when my tax base is more than my book base. So this is a thumb rule. So we'll move to the next slide then. Okay. Now we'll spend some time in understanding the concept of recognition rule for deferred tax assets. So general rule, recognize DTA for all deductible temporary differences to the extent probable that the taxable profit will be available. So here recognition is subject to the fact that we have to make sure that assess that for each of the accounting year that probable that a taxable profit should be available. Likewise for unused tax and losses and unused tax probable that future taxable profit will be available. So key condition, use prudence. Don't recognize DTA. Future tax profit is doubtable. Review at each reporting date. Write down if not recoverable, reverse where probably. So simple funda that we have to recognize the DTA only if we are probable that we are having the future profits. Then we are going to recognize it. Otherwise, we are not going to recognize it. Also, for any earlier recognition of DTA, we have to take a decision whether we need to reverse it or not, depending upon the fact that we are not sure about the profitability in the future years. So example, DTA on carry forward losses, tax carry forward losses 8 lakh, tax rate is 25%, DTA would be created on 25% of 8 lakh, which is 2 lakh, but company has had losses for 3 years, and now they form 5-year contract with the forecast of the year, so it become probable that a future profit will absorb the loss, and hence DTA has to be recognized. For asset creation, DTA deductible temporary differences. If for asset side, so this is reversal of my DTL. In the DTL, we have to create DTL on the asset side. If my book base is more than my tax base, it is reversal here. So for deductible temporary differences, we have to create DTA if my tax base is more than book base on the asset side, and reversal if my book base is more than my tax base in the liability side, then we have to create the DTA. So rules would be reverse in the case of DTA. So we'll move to the next slide and see the exceptions that we were talking about, three exceptions. So we are going to speak about those three exceptions in the next slide. Okay. So we talked about those three special cases when we were talking about the DTL. So now we are going to touch base each of them in detail. So special case and exception, initial recognition exemption. So no DTL on initial recognition of asset liability if it is not on a business combination. If it is a business combination, then we have to treat it differently. But if it is not a business combination, then no DTA or DTL to be recognized on the initial recognition. At the time of transaction affects either accounting or taxable profit, the transaction is not having impact on the temporary difference in a symmetric way. So which means that if let's say we have acquired a particular asset on which on the initial recognition there is no change in the value with respect to my accounting as well as the taxable profit, then we do not need to recognize any of the DT and DTL. Typical example here is that leased asset. At inception, for some leases where tax base is equal to cost, no temporary difference arises initially, even if one of did not. For example, when we have created at inception of the lease, there is normally a concept of wherein we have to created a right ROU, basically we normally call ROU, right of use. Then we have to create a lease liability. In the initial phase, both my asset as well as the liability is equal to same. And as per the Income Tax Act, it only happened that we have to charge expense if I'm actually paying any of my lease liability during the financial year. But in the initial recognition, when we are creating a particular ROU and creating the equivalent lease liability, there is no need to recognize any asset or liability DT or DTF. We are going to talk about it in detail in the example. We have a very separate example for this. Likewise, for goodwill, no DTL is recognized or taxable temporary differences relating to goodwill arising from the business combination subject to the specific condition. We have a detailed example to it. So we are saying goodwill of 5 lakh recognition consolidation. Tax base for the goodwill is 0, not deductible. Temporary difference is 5 lakh taxable, but IND AS 12 does not allow DTL on this portion of the goodwill. The reason being is that this is being created as a time of a business combination, and hence if we create any DTL to this, then the second leg will go to my goodwill itself. So which will create a loop in terms of creating the iterations of the DTL at every time we are creating that entry in the books of the account, because it is not going to charge to my PNL as per the IND AS 12. So if it is not going to charge to my PNL, then it is going to create a loop. So we have to again make sure that this loop should not exist, and hence we do not create any DTA or DTL at the time of the goodwill, at the time of the business combination. So we are going to again have a look at it through an examples. We have an example to separately talk about this in detail. So we'll move to the next slide then. Okay. So we'll come to the third example here, which is investment in subsidiaries, associates, and JVs, joint ventures. So what we are saying here, for taxable temporary differences on investments, recognize DTL. So which means that we have to recognize DTL as normal, as we are doing for normal entities, only if we have not recognized DTL, only if the parent can control the timing of the reversal. So which means that a typical case would be dividends, which is being controlled by the parent. So they know that whether they need to declare the dividend, whether the joint venture will declare the dividend or not, if they are holding that right. So in that case, they will not recognize the DTL, and it is probable that the difference will not reverse in the foreseeable future. Likewise, for deductible temporary differences, we have to recognize DTA only if it is probable that they will reverse in the foreseeable future and there is sufficient profit to it. So these are like two exceptions. For DTL, we have to do recognition as a normal course. We do not need to recognize the DTL in normal course only if the parent control the right for they control the timing for the reversal, and it is probable that there is a difference will not reverse in the foreseeable future. For DTA, it has to be done only if parent has that visibility in terms of the probability of the existing of the future profit, so that they can recognize the DTA. Example, parent company was 80% of the subsidiary. Subsidiary made 10 lakh profit recorded in its net asset. Parent shows increased investment value due to the consolidation adjustment. Tax law imposed tax on the dividend only when distributed. Temporary difference. Carrying amount of investment rise, but tax does not. This is a taxable temporary difference. DTL not recognized. Why? Because parent control the subsidiary. It control whether the profit will be distributed or not. If parent decide not to take the dividend, temporary difference will not reverse. Treatment of there is no TTL on the undistributed profit of subsidiary if the parent controls the dividend policy. Simple. So if it means that parent has the control on the outcome of certain action that will trigger the DTL, in that case DTL will not be recognized. But if parent do not have control on the triggering event, then it has to be recognized in the course. Now we are going to look at the example that we showed in the last slide. One for the initial recognition and second for the goodwill. Okay, so let's just quickly have a look at the special cases example, both for the asset side and liability side. So what we are saying here is that when asset side purchase an asset where a tax depreciation is not equal to book depreciation. So company purchased a machinery for 1 lakh, 10% is SLM as per the books, 25% WDV as per the Income Tax Act, tax rate is 30%, asset is 1 lakh. So no difference on the day one. Even though the future temporary difference will arise, and AS12 prohibit recognizing detail on the day one, because transaction is not a business combination, and on the date of purchase it affects neither accounting profit nor the taxable profit. This is an example on the asset side. And on the liability side, lease liability under 116. So entity enters into lease. ROU is 5 lakh. So basically, whenever we have leased assets, we have to create ROU and lease liability. And both these are like an asset. ROU is an asset, and lease liability is my liability side. But for income tax, ROU asset or lease liability is not recognized. Tax deduction only arise later when the people when the lease payments are made. So in this case, my book base is 5 lakh for that particular liability, but my tax base is 0. So which means that in very ideal scenario, I need to create a DTA. But since a temporary difference is 5 lakh, create DTA, but both DTA and the DTL will not be done on initial recognition because the transaction is not a business combination. It affects neither the accounting profit nor the taxable profit at the time, and temporary differences are symmetrical. So these are like example when we do not need to create the DTL or DTL at the time of initial recognition. Subsequent recognition will definitely need the creation of the DTL or the DTA as the case may be. Now we go to next slide and see the example of the goodwill. Okay, so now we are going to talk about the example on the goodwill, which is another exception to our general rule. So example is business combination creating goodwill, DTL not allowed. Scenario, company A acquires company B for 10 lakh rupees. Fair value of identifiable net assets acquired is equal to PPE 6 lakhs, inventory is 2 lakh, net assets is equal to 8 lakh. Tax base for the PPE is 5 lakh, inventory is 2 lakh. So goodwill is equal to the purchase consideration, that is the amount that we have paid, which is 10 lakh rupees, minus the fair value of the asset, which is 8 lakh rupees. So we have a goodwill of 2 lakh. So what we have to do, step one, identify the taxable temporary differences. For PPE, fair value is 6 lakh, but my tax base is 5 lakh. Temporary difference is 1 lakh rupees. Normally, because my book base is higher than my tax base on the asset side, it will create the DTL. But when applying the acquisition accounting, we have to create DTL at the rate of 30,000. If we recognize this DTL should be debited to the goodwill, because Ind AS specifically prohibits the accounting for this particular DTL in the books of accounts. So what will happen if we recognize this DTL will be deductible debited to the goodwill? Goodwill would be 2,30,000. So 2,30,000 will be inflated goodwill. Ind AS prohibit this because Ind AS do not do the recognition of the business combination goodwill arising on account of business combination. Therefore, no DTL is recognized for this taxable temporary difference, even though PP has a taxable temporary difference of 1 lakh. DTL is not recognized if it rises from the goodwill calculation. The logic is goodwill is computed as a balancing figure. If DTL was created, goodwill must be increased. That increase creates another temporary differences and it becomes never-ending loop inconsistent with the Ind AS 103. So we have shown three exceptions. We have shown the examples of those three exceptions as well. One is initial recognition. Second is joint ventures, subsidiaries and associate. And third one is goodwill. And we have confirmed that we have showcased that DTL needs not to be created, why it has not to be created. So we now move to the next slide. Okay. So we spoke about the measurement and recognition of the current tax. We also spoke about the recognition of deferred tax. Now we'll talk about the measurement of deferred tax. So key principle is that use the tax rate and enacted or substantially enacted by the reporting date. Reflect the expected manner the recovery and settlement used to use through use example depreciation asset, through sale example non-depreciable asset. So likewise through sale non-depreciable largely basically when we are talking about if we are selling an asset and there is a capital gain, so we have to take the rate of tax which is applicable on the capital gain for that particular asset. So example, different rate can be used for use versus sale. PPA carrying amount of 10 lakh, tax basis 7 lakh, temporary difference is 3 lakh. We use tax rate as a normal tax rate. But if let's say we are selling the that asset, then we have to take rate as a 20%, which is the applicable tax rate for the capital gain on the sale of an assets. So this is how we'll measure the deferred tax. So we'll move to the next slide then. Okay. So we'll talk about where to recognize in the PNL, in the OCI or SOCE. So principal tax follow the underlying item, profit and loss, most current and deferred tax go to the PNL. OCI if the related item, example FV's OCI, equity cash flow, hedge revaluation goes to. So any treatment specific income which is like on OCI because of the fair value that will be dealt in the OCI. If an item goes directly into equity, example some share transactions, share based payments, related tax will go into the equity. Business combination, deferred tax recognition affects goodwill or the bargain purchase gain. Example, tax on FVS COI equity investment is gain of 1 lakh included in 1 lakh. It is included in OCI and related detail will also be accounted for in my OCI. So thumb rule, all the recognition will be show of detail in the PNL. For OCI, it will show in the OCI if the related expense or the rather it's largely the expense or income on the fair value that will be shown on my OCI. So related and applicable DT or detail will be shown in the OCI. Likewise for my SOCE if the item is directly related to my equity. So with this, I think we'll move to the next slide. Okay, so we'll quickly talk about the presenting and offsetting here. Presenting is that we have to present the tax showing separately the current tax and the deferred tax so that we can show it properly at the major component. Offsetting is only allowed if it is legally enforceable right to set off and intend to settle net show as a net specifically for the current tax, and for deferred tax it is only allowed if it is legally permittable for this current tax and same tax for the same taxable entity and the taxation authority. But if it is not permitted, if the entity is different, my taxation authority is different, then we cannot do a set off. Then it has to be shown the cross basis. So we'll come to the end of this presentation. We have one more slide. We'll quickly have a look at that slide on the differences between IND AS and the IAS 12. Okay, so I think there are no differences as such between the IND AS and the IAS 12. Almost everything is same. Some mechanics and some differences in terms of language is there, but otherwise it's absolutely the same. This is the last slide, but as we promised that this is the part 1, so we are going to come with the part 2 which will have detailed examples on each and every scenario so that a user could able to absorb it more deeply with more and complete understanding, and then they could able to understand each and every concept, that how the treatment of unabsorbed losses or carry forward of losses is being concerned, what happen when the rate changes, what if a particular temporary difference is creating a particular DTA in the year one, can also create the DTL in the year two. So all these scenarios will be discussed in the part two. So we'll quickly go to the closing slide then. Okay, so this is the last slide, which is thank you slide. So I would like to thank all my viewers and subscribers for watching this presentation in detail till the end. And it is my sincere request to please like this video, subscribe our channel, share this video, and also cascade it to as many people as you can, so that they can also take advantage of these kind of sessions and they can refresh their knowledge. So we'll come up with the second part to this income tax for IND AS 12, wherein we are going to come up with the detailed examples. So till then, thank you, goodbye, and have a nice day.